The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Risk aversion returns to financial markets. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. And boy, a lot of intraday volatility on this Thursday. The S&P 500 down by about 0.7%. We're off our worst levels of the session, but a totally different picture than where we opened at this morning. Higher by more than 1.5% at one point, coming off of Nvidia earnings, Walmart earnings, totally erasing those gains. The Nasdaq 100 now down by 1.3%. The VIX rising, as you might expect, currently trading with the 24 handle just about at 25, though we were trading near 27 earlier. And then Bitcoin, its bad week continuing, down another 4%, Romaine, and well below that $90,000 threshold. Yeah,
quite a difference, a few hours to make. That sigh of relief that you heard at the start of the trading session this morning on the back of decent earnings out of Nvidia and Walmart, that's now flipped to cries of frustration. Nvidia's earnings, they were solid. Jensen Huang's outlook, as usual, lofty, but a deeper dive showed a glaring problem. Revenue growth of 62%, phenomenal, but that was outpaced by an 89% jump in accounts receivable. A big fundamental red flag, and that was further outpaced by a more than doubling in Nvidia's chip inventories, which seems to be tied to effectively being shut out of the Chinese market.
It would be fantastic if we're able to participate in the China market, but for now, we should just assume our Nvidia's forecast for China market is zero. We're going to continue to engage the U.S. government, continue to engage the China government to advise them and to encourage them to allow us to go back and compete in the open market. And so until then, we should assume zero.
And those comments, along with some other dives into that earnings report, has Nvidia flipping from a 5% gain at the open to what looks like a 3% drop heading into the close. A downdraft exacerbated by lopsided broad market positioning that is forcing systematic funds to quickly unwind some of those long positions. You see that reflected in what is now the widest intraday trading range for the S&P since April. You see that in Bitcoin hitting a lower low for a 10th straight day. And you see that in a VIX that is set to settle above 20 for a fourth consecutive session. Not helping matters also is that spate of long-delayed government data that seems to suggest an economy far from in the best of places. The labor market report particularly being singled out for showing weak cyclical hiring among employers and elongated periods, Katie Greifeld, of people on unemployment assistance.
Let's put that into context right now. I have the chart behind me. When it comes to the September jobs report, it came in better than expectations. 119,000 jobs added into the economy in September. That is well above the expectations of 51,000. You can see it's the first print in a while that had broken that 100,000 mark. But still, you take a look at the revisions, none for, of course, the most recent print, but you can see that number has been negative for a while. And even though we're talking about a better than expected report, we're talking about the September jobs report. We know that we're not going to get October, November on the way. You have to wonder, even though, of course, we finally have this print, it's better than the expectations. How much does it really matter to the Federal Reserve as they head into their December meeting?
Well, let's pose that question to our first guest. Michael Feroli is the chief U.S. economist at J.P. Morgan, joins us here in Studio 2. Mike, this report I know is just going to be one part of that broader mosaic that the Fed is going to have to consider in about 3 weeks' time. Did it give you any more clarity?
Not as much as we had hoped. But I think you have to take this report in conjunction with the minutes we got yesterday and with Powell's remarks previously, which suggests that, look, it's going to be a very close call, I think, when the committee decides in December. We are starting to lean toward them skipping this meeting, again, based in part on the fact that it sounds like a lot of people on the committee are similarly minded. Also, you didn't see any real, while the unemployment rate did tick up, the momentum in the labor market may be turning around. It's a little soon to say. We wish we had more data. And while their mandate is in terms of employment and inflation, we shouldn't lose sight of the fact that next Wednesday we'll get a GDP report, which we think could be easily 3%. Atlanta Fed has it at over 4%. So that could matter as well.
But with regards to the momentum in hiring, the potential that we do maybe see a little bit of a turnaround in that space, there was a lot of concern about this idea of just how narrow the job growth was in the most recent, something like only 2 sectors basically accounted for all the growth. Does that not concern you?
So the diffusion index, which is the percent of industries that were hiring, actually rebounded to its highest since February. So you did actually see some more breadth. You saw some sectors like construction, the trade trade groups also pick up their hiring. So yes, previously it had been just healthcare and government. Now we're seeing a little more breadth. Again, 1 month doesn't make a trend, but we wish we had more data, but we don't. So that's the way it is.
I want to bring the conversation back to what the Fed does next month.
Yeah.
We saw the economists, your peers over at Morgan Stanley, no longer expecting the Fed to cut in December, but on net, our broad outlook for Fed policy has not changed. So you said that you would expect the Fed maybe to skip this meeting. Does that imply, too, that when it comes to where they go in 2026, that view hasn't necessarily changed?
Yeah, and I think, again, that's a message we heard yesterday in the minutes, which is most of the committee continues to anticipate cuts, but they're not in a hurry to do that. And I don't think this number would give you a sense of hurrying or a need to hurry, right? So I do think that, generally speaking, feels like most people on the committee do want to continue to lower rates. They just don't want to rush into it. And again, I think you heard that even in some Fed speak just today as well.
Mm-hmm. Well, you make the point that we have plenty of debating points for both hawks and doves. And it sounds like both factions have been very, very vocal. Does that mean anything to you beyond that we're going to see dissents when it comes to the December meeting?
Well, look, right now, both aspects of their mandate is being challenged. Unemployment is drifting higher. Inflation is high. And so it would be weird if everyone were singing from the same hymn. So I think it's actually a sign of a committee where you have a lot of independent thinkers coming at a very challenging problem and weighting the facts and weighting their preferences a little bit differently.
How much does the actual potential for a rate cut really matter in terms of actually getting the economy on better footing? I mean, is a 25 basis points or even a series of 25 basis point cuts really going to change the dynamics?
Well, a series would. But the question is whether, we've already gotten some insurance cuts over the last 2 meetings, which gets you in a position closer to neutral. Now, it's never the case that one cut or one hike is going to matter all that much, but to the extent it's part of a broader cycle, it will matter. But it just doesn't feel like maybe there's the same urgency that there was. Certainly, let's take late last year, or maybe even with the most recent meeting as well.
Yeah.
I am curious, when you take a look at the two sides of their dual mandate, when it comes to the labor market, when it comes to inflation, again, both sides very vocal right now, but there have been a lot of articulated concerns about inflation here being stubborn where it is or potentially moving higher. And I wonder if you share that concern as well.
Well, the stubborn part, yes. The moving higher, not so much, right? Today we had average hourly earnings, which again is consistent with the labor market not being a source of inflationary pressure. That being said, we probably haven't seen all of the tariff price pass through. So I do think we might be stuck in this range in the upper 2s on core PCE inflation for longer than would make a lot of people on the FOMC comfortable.
With regards, though, to the future outlook, kind of looking into 2026, there's been a lot of talk about some of the provisions that were in that big spending bill that we passed earlier this year, and how some of those don't really trickle into the economy until next year. Do you see the potential for a bit of a tailwind from some of those provisions?
Yes, definitely. We do think that some of those new provisions of the big beautiful bill, like the no tax on tips or overtime, that might give you about a 1/4 percentage point of GDP growth next year. So we do see, a little bit of fiscal support helping the economy next year. Not a big knockout blow, but a little something.
All right, Mike, always great to talk to you. Mike Feroli, Chief U.S. Economist at J.P. Morgan, kicking us off to the close as we take a closer look here at the state of the economy and, more importantly, the state of the consumer. A conversation up ahead with a legend in the apparel industry. Mickey Drexler going to join us to talk about some of the trends that he's seen in the consumer and apparel space as we head deeper into the holiday season.
And from iconic retailers to the marketing behind those iconic brands, Jenna Lyons and Johnny Bauer of the Fundamentalco discuss how they're tailoring identities for their clients, including those in the red-hot private sector.
And we're also going to talk tech. We're going to talk to the CEO of T-Mobile. What's next in the world of wireless as the company set to make a major announcement today, straight from the Las Vegas Grand Prix. Stick with us. A lot more coming up here on The Close. This is Bloomberg.
Well, one of 2025's standout statistics is that U.S. ETFs officially outnumber stocks, and now 2 of Wall Street's most storied firms, Vanguard and Wellington, deepening their partnership to grow that pie. Earlier this week, they launched 3 active equity ETFs, chasing value, growth, and dividend growth, meant to diversify portfolios for the long term. Joining us in studio, I'm pleased to say Ryan Barksdale. He is head of active equity product over at Vanguard, as well as Kim Gailun. She is senior managing director, partner, and head of equity boutiques at Wellington Management. Great to have you both with us.
Thanks for having us. We're excited to be here.
So I'm going to start with you, Ryan, because the Vanguard-Wellington partnership, it goes back to day one of Vanguard. That means it's 50 years old. But as I understand it, these are your first partnerships in the ETF wrapper specifically. So first question, what took so long?
Well, again, thanks for having us here. We're really excited to talk about these ETFs. When we think about product development at Vanguard, we don't think of it as a race, right? Mm-hmm. We want to make sure we're developing products for the long term. And the long term for us is decades in advance, not just a year or two. So we spent a lot of time behind the scenes being deliberate about what are the products we want to offer our end investors and how do we offer them at the right price for our end investors. So, we're really excited to marry the capabilities. You mentioned the 50-year partnership with Wellington. Vanguard also has 25 years of experience with the ETF wrapper, so we're really excited to marry those capabilities and meet our clients where they are.
Well, let's talk about the debut offering here. We have the Vanguard Wellington Dividend Growth. As I said, you also have active growth and, of course, value. So, Kim, talk to us why these three strategies make sense to put into the ETF wrapper and where else on the spectrum you might go.
Yeah, sure. So, when we first started talking about this, which was some time ago now, what we really wanted to do was bring to market some core building blocks for a U.S. equity portfolio. And so we've been studying the market for a while. We wanted to bring strategies that have track records and that have proven investment managers. And so starting out, large cap U.S., value, growth, and defensive core was the right place to start. In terms of what's next, to be determined, I think we do hope that this is the first in a series of launches, but more to come.
I am curious, Kim, if you can talk a little bit about, at least let's just take the growth fund, for example. When you talk about the types of stocks that go in there, the idea of transformative or disruptive companies, what are we talking about? Yeah,
so the growth fund, it's not a tech fund, as you might think when you think about growth and transformation. It's an all-industry fund, so it's a diversified fund focused on higher growth companies who have some element of innovation to their story.
I am curious, though, too, also, Ryan, about this idea of actively managing these funds at a time. Particularly, I know we're trying to keep fees low, and Katie and I was joking earlier today about how this is like one of your most expensive funds ever, though it's, obviously on a percentage basis still pretty cheap. But it gets to this idea of trying to maintain some degree of alpha at the same time having that added cost.
That's right. Yeah. So the goal is simple with active. It's to outperform over a long period of time. And whether that's in a mutual fund or an ETF, if you don't have the outperformance, then what are you left with, right? So we are quite sensitive to that. Do you feel the
pressure then? Is that?
Do we feel the pressure? Well, the pressure is always there, right? And but the idea isn't to outperform each and every day, right? So that's why we do feel like we have the benefit of a long-term perspective, right? Here at Vanguard, but also in our partnership with Wellington too, right? It goes back 50 years, as we've described. We think we're well aligned culturally, and we are truly trying to improve outcomes for clients over the long term.
Well, let's talk about that relationship a little bit more and what the future of active looks like at Vanguard. Because with these three specific funds, as I understand it, it's Wellington that's actually picking the stocks. But we know that Vanguard is making a big push into active. These are, of course, Vanguard's first stock-picking fundamental equity ETFs. And when you look into the future, I know that you have a quantitative stock team. Could you see hiring a team to do the stock picking within Vanguard itself?
Well, what we want to do is to expand our lineup over time. And we've had 50 years of expanding the mutual fund lineup. And I think you make a great point. We obviously have an important partnership with Wellington. We have important partnerships with 20-plus sub-advisors. We have a critical partnership with the quantitative equity team that you refer to. So I think there's opportunity as we look forward to introduce ETFs, one, if they meet the client need, right? So I think that's the most important thing for us. We want to make sure we can help clients build effective and efficient portfolios over time. If we can marry the capability from an active standpoint from current partners, both internal and external, we're going to do that.
Well, you make the good point that, Wellington is just one of several sub-advisors that you work with. 20, I believe, is the figure. As you move forward in this active push, do you think that number could come down?
Well, the number will remain, where it is because, those are really important partnerships as it relates to our overall franchise, which at this state is largely on the mutual fund side. Now, where we wanted to start here was really looking at the relationship we have with Wellington and the conviction we have. One of the fantastic aspects of Wellington is that you have individual portfolio management teams with very disciplined, time-tested strategies, but then they benefit from a global investment platform. So it was very attractive to us, which contributed to these first 3 products.
All right, well, definitely something to watch here. An interesting partnership right now between Vanguard and Wellington. Ryan Barksdale, head of active equity product at Vanguard. Kim Gailun, senior managing director, partner, and head of equity boutiques over at Wellington Management. When we come back, we're going to focus in on one of the hottest sectors in the market, and it's not actually big tech. It's, big biotech. M&A in the healthcare and biotech sector continuing to rise this year, including the deal that we just learned about today. Confirmation of Abbott buying Exact Sciences on a day here where we see biotechs here trying to outperform the broader market. That's coming up next here on The Close. This is Bloomberg. All right, well, the broader market is down deep on the day. Biotech stocks, at least as measured by the XBI ETF, unchanged on the day here, and that really is reflective of some of the strength that we've seen all year long in that space, fueled in large part by deal making in neurology, in obesity, drugs, and oncology. Of course, we were just talking a little bit earlier about that big deal between Abbott and Exact Sciences. Joining us right now here in Studio 2 to talk a little bit more about what the future holds in this space is John Flavin, founder and CEO at Portal Innovations, biotech executive who's now trying to fund the next crop of biotech executives. Great to have you here.
Pleasure to be here. Good to see you, Romain.
I mean, we've been talking all year long about GLP-1 obesity. We know that's a big market here, but we kind of forget some of the progress that has been made in some of the other areas like neurology, and of course with Exact Sciences, a renewed focus by a lot of these companies on oncology.
Absolutely. I mean, oncology, the beauty of some of the breakthroughs on the therapeutic side is new modalities that are, improving and extending lives in cancer in previously untreatable tumor types. Mm-hmm. But as that happens, we've also learned that diagnostic tools can predict, and using those tools and finding cancer early can lead to better outcomes. So if you look at what happened today with Abbott buying Exact Sciences, mm-hmm. from a commercial perspective, obviously it expands the cancer franchise for Abbott, mm-hmm. but at the same time, it's kind of a fun story to think about when you go back to the origins of Exact Sciences. Yeah. It's very much, that classic story of an innovator. A lot of the early science came out of Johns Hopkins University, mm-hmm. Brett Vogelstein, and then a collaboration with Mayo Clinic, mm-hmm. David Ahlquist, and then Kevin Conroy came along, put the package together, and really built an amazing company that now is able to bring these diagnostic tools to patients. And that's really the opportunity.
Well, with regards to those diagnostic tools, I mean, in the past, when we talked about the biotech industry, it was always about sort of that one killer, or actually killer, but that one sort of big drug that was going to be the treatment for whatever was ailing you. And we're seeing a much more of a focus on preventative medicine, the idea of being able to diagnose and scan yourself way earlier in that process so you don't end up with the more extreme version of whatever disease or ailment.
And so much of that is a product of, the genomics revolution, mm-hmm. going back to the, early days of, deciphering the human genome, and fast forward to today, those discoveries and the ability to use those tools now at scale, mm-hmm. with supercomputing, allows us to be much more precise with understanding what is the genetic mutation in a cancer type or other diseases, and how do we assign and prescribe the right drug to, mm-hmm. be able to be more effective, because drugs themselves always will have some untoward or off target effect, which leads to side effects. So the more precise we can be, mm-hmm. with the capabilities of that drug by understanding the diagnostic tools, we'll be more effective at treating patients.
Well, I'd love to tie this conversation into what we're seeing in the political environment as well, because that's been one of the hot topics this year, is what does funding look like, particularly at the NIH level. So when you think about all the smaller companies in the space trying to develop these drugs, what does the state of funding look like, not just from private investors, but from the government as well?
Well, there was a lot of noise early on. If you go back really almost a year to the day, RFK Jr., was brought in place, to be Secretary of Health and Human Services. So the industry was somewhat concerned about that appointment. If you fast forward to today, Marty Macri, the head of the FDA, had a bold vision, and his bold vision was to accelerate drug approvals, especially in rare diseases. And there's been some turmoil and turnover in the ranks of the FDA. Really good news. We've got Richard Pazder coming in as the head of CDER.
Right. Yeah.
But those things, really, those fears have kind of waned off. As it turns out, NIH funding has continued to remain steady. It's certainly cast a lot of concerns.
But is that eagerness and innovation there? Because, I mean, to your point earlier, I mean, we talk about, the COVID pandemic and Operation Warp Speed, which probably was one of the greatest, achievements that we've had as a country, certainly on the healthcare front. Yet you have an administration that almost seems hostile to the same science that the previous administration sort of lauded.
Yeah, I mean, there's no question about it. We're living at a very confusing time when it comes to policy. What we're trying to look at from an investor perspective is, and back to look at the markets today, up 25% in the XBI index. And that came out of a deep hole. I mean, we've been in really a nuclear winter for the past several quarters. So what's driving that? What's driving it is innovation. So these breakthroughs are leading to better treatments and better outcomes for patients. We predicted and are now seeing more funding coming from alternative sources beyond the government. Venture capitalists, but also, like, we have a company that's going after a Parkinson's disease. It just was awarded a $5 million grant from the Michael J. Fox Foundation. States are getting very aggressive in investing in innovation. So we're partnering with the state of New Jersey around the New Jersey Innovation Hub. So Rutgers, Princeton, a lot of cool stuff happening there. But in investing through the state instead of through the federal government is becoming more prevalent. Right. Texas, the Cancer Prevention Research Institute is a $6 billion fund that's investing into companies. Three of our companies, Iteraon, Crossbridge, and Novascan, were awarded $25 million. So where the federal government may be pulling back or confusing people, other sources are popping up.
Right, so there's that diversity there when it comes to funding sources. It's not all the government. John, we could keep going. Unfortunately, we have to leave it there. Hope to keep the conversation going soon. That is John Flavin. He is founder and CEO over at Portal Innovations. Now, coming up next, retailers sending mixed signals about the strength of the consumer. We'll cut through the noise with Mickey Drexler. He is chairman at Alex Mill and the former CEO of Gap and J.Crew as the holidays near. That conversation up next. This is The Close on Bloomberg.
I'm actually cautiously optimistic. The trend over the past few months has been amazing at Bloomingdale's, so we feel pretty strong. We feel pretty strong about our customers' feedbacks, about our partner feedback, about the current trend that we're experiencing, and we're building such a great event for this holiday season that we're convinced that it will resonate very, very well with the customer. The customer now, 3 years ago, was all about luxury, high luxury, etc. We can feel that customer changes, behavior changes a little bit, a bit more to high-low, to contemporary, to luxury. And you know what? This is exactly what Bloomingdale's is about. So we feel very, very strong about this.
Part of the conversation we had yesterday with Bloomingdale's CEO Olivier Braun about his cautious optimism heading into the holiday season.
Yeah, and certainly he's not alone in that cautious optimism because the consumer seems to share that same optimism with a survey out of TransUnion showing that more than half of consumers plan to spend more on holidays this year versus last year. Joining us now is Mickey Drexler at the desk. He is the chairman of Alex Mill and a force in the retail industry, having held CEO roles at Gap and J.Crew. Mickey, first off, it's great to see you.
Nice to see you.
So let's talk a little bit about this consumer, because that cautious optimism, it's there. If you talk to certain people, other folks would say that the consumer is totally tapped out and there's just not that much pricing power left when it comes to these retailers. And I wonder, when you survey the landscape, what do you see right now?
Well, it's funny. I don't know who TransUnion is, but I don't know how you get answers to a survey like that.
Yeah.
I am a cynic when it comes to surveys. I survey customers, I survey people in our shops. But how do I see the landscape? Very, very promotional. I think Black Friday started like last Monday. And every time I'm on here, I go online and I look at the prices and the cuts. 50% off here, 40 off here. Very few of us included, don't do that. Because once someone tells you, wait to buy it, you're always waiting.
Yeah.
And I always use my friends at TJ Max, who I spoke to today, and they don't have Black Friday events because they are every day.
But they are a discounter. But for those folks who aren't discounting, you mentioned Alex Mill. There are a lot of other brands out there, Sid Mashburn, that kind of holds the line on prices. How do they do that and not succumb to the price cutting that everybody else is doing?
First of all, have to have a vision of what business you would like to be in. Costco is impeccable. I don't know if you call them a discounter or just great retailers. Same with TJ Maxx, and there are others out there. But, you know, and I said this, quoted, you know, quarter to quarter, you know, they kicked my old friend from Lululemon, Chip. He took out that ad, and then the Wall Street Journal called and said, what do you think of that? I didn't even read it, so I read it. I said, I agree with every word he says. It's quarter to quarter. You know, long term in this world is quarter to quarter.
Right.
And you're not a turnaround person unless you marry your business and marry your job, and you want to see it. And for me, I love what I do, and my standard is I need to do what I did better the next time. But I count for it by it's easy to promote, but it goes short term.
Right.
And I don't know how good business is. We are flying right now.
Yeah.
Took 5 years to get there, but it's all about the product. The marketing is critical. And the team, no one does it alone.
Well, Mickey, you've seen a lot of different economic cycles, and I wanted to talk a little bit about the psychology of the consumer right now, because I hear what you're saying, that if you offer a promotion consistently, people are going to expect that. But you think about the cycle that we're in right now. Prices are high. They don't seem to be budging, even though the rate of change has cooled significantly. I mean, okay, maybe TJ Maxx is in a unique situation, and they are a discounter, as Romaine points out. But you know, if you're at a slightly higher price point and you have folks waiting for a promotion that you're never going to give, who blinks first?
Well, you're dead long term if you do that. When I took over Gap and then J.Crew, they were discount companies. Gap, 2 jeans for $26 from Levi's. Who blinks first? You don't blink. You just do your job every day. And you don't worry about the, look, I hated quarter to quarter earnings. When we dropped a quarter, boom, you know. But who blinks first? I think the consumer always knows. They're smart. They go online. It's amazing how many retailers today have 2-tier pricing. Online, 50 off the whole store. You go into the store, they don't tell you unless you ask. And just the best education you get is going online. You see everyone online and what they're doing.
Yeah, I am curious though too about just how people are shopping, not just this holiday season, but long term. We were just showing you that clip from the Bloomingdale's CEO. We're talking about a traditional department store, and we know department stores have been struggling, whether it's Macy's and Bloomingdale's or Dillard's or Nordstrom or whatever. Is there a future to that sort of big box department store model? I mean,
well, you know, for 30 years I've been saying, well, there were a million department stores. I started my career in 3 big department stores in New York. I stayed 12 years, and I felt, for me, I was a young guy. There was no real future. And everything I did...
All the way back then you felt that?
Well, I'll tell you why. I was a buyer at Bloomingdale's, and Alexander's, an old discounter, was across the street.
Yeah, and this where this building is
They
right now.
had my goods, same goods I had, swimsuit sweaters. I had to mark down my inventory. How do you control your business having to price off of your competitors? I want to own our products, and that's what I learned from my experience, that if I'm dealing as a discounter in a department store, I have to meet prices. I always say, and I said it on here, before you pay for anything and give them your credit card, go online and look for the deal. It's somewhere to be had. And how do that's why I'm a big believer in own your product and own your brand. And look at what Costco's done with Kirkwood or whatever the name is. It's like bigger than most corporations. So.
But you're seeing some other retailers try to do that as well. I mean, Macy's has a big private label brand that they've been trying
private label in itself is market high and sell it on sale. It's the integrity of product. And I see it not just in our industry. I see it in the car business. All of a sudden, every car looks alike. I don't know, they all have that swoop.
Except for the Cybertruck, but that's a different conversation.
Oh, which one? Oh, my God.
God, don't get him started. Please, lady.
We can have that conversation off air. But when you think about the future of shopping and how people actually shop, I do wonder if, physical stores will eventually turn into sort of a showroom. You go into the physical store, you try things on, and then you go and you get the better price online, or you're able to get more colors or a slightly different size online. And I wonder if I'm alone in that opinion.
Well, it's your opinion, and I can't argue what you think, but I think there's an emotional connection in our business. That's why I say AI. Everyone's saying it's going to replace this. It doesn't have emotion. It can't pick colors. And you go into a store, a physical store, it's like a work of art if it looks good. Mm-hmm. Now, most of them don't. But the main thing is the main thing. It's nice goods at a fair price. And I'm a color person for our business.
But it's funny, you bring up the analogy with cars, and I mean, we know cars have really gotten very sort of similar in styling, colors, everything else. You're also seeing the same thing in fashion to a certain extent as well, certainly at a certain tier of fashion where it's all kind of the same stuff.
Well, I think, look at the designers, by the way. They're going through a period where you look at the retails.
Yeah.
I mean, I don't know if what I read is right, but they're suffering because I know what it costs to make a cashmere sweater. And we used to make them with Laura Piano yarn at J.Crew. I'm seeing $2,000, $3,000. I look through the magazines. I love what's going on there because we're waiting around with the other high quality, good value styled retailers. But I think it's about a merchant, it's about a vision. And you don't learn any of this in college, which students don't like to hear me say. It's like in your business. You didn't learn how to do what you do. Now, all the parents don't like what I say that to their kids in college because you want a lawyer to learn law. But our business is a creative business, no matter what. It's a business where you see it, you feel it. And I always say, for me, if I don't get emotional about merchandise, then it's fair. So.
All right. Well, you've done well, and obviously you've proven yourself, and a lot of folks now trying to replicate what you've built. Mickey, great to have you as always.
Thank you very much.
Mickey Drexler, of course, a legend in the apparel and retail industry, chairman now of Alex Mill, and formerly led Gap and J.Crew. And also a reminder that a little bit later today, we are expected to get earnings out of Gap as well. All right, when we come back, we're going to focus in on the broad market, the big flip-flop that started off as a rally on the back of decent earnings out of Nvidia and Walmart, now turning into a little bit of, reflection here as people try to digest the state of the economy. That's coming up next here on The Close. This is Bloomberg. All right, it's time now for our stock of the hour, and quite frankly, it's an index of the hour. You look at the sea of red on your screen today. Tech, Nvidia, all reversing gains from earlier in the day. Concerns over lofty valuations and concerns about the AI boom and whether it is indeed a bubble. Norah Mulinda joins us right now around the desk to talk about an interesting move. I mean, we were all sitting here last night. We saw the report out of Nvidia, a great quarter. Jensen Huang, of course, promising the moon for the future. And it looked like for a few brief minutes at the start of the session, the market was all on board with that. Then what happened?
Right. I mean, the bulls certainly had their victory lap if you look at what happened earlier in this morning. But I do think of Nvidia essentially as the fulcrum between the bears and the bulls right now. You were seeing a bit of a tug of war as we were heading into this print in particular. But of course, we are seeing resuming just the fears, the concerns about the fact that we're potentially in an AI bubble. So a lot of people are looking for return on investment. They're looking for some sort of understanding and some sort of promise here that we're going to actually see all the things that are being laid out here come to pass and come to fruition, and seeing a lot of the metrics supporting that.
Fulcrum is a really good vocab word. I won't meditate on it too long, though, because there's a lot to talk about when it comes to these markets. What's interesting is that you had actually okay breadth when the session started. Now that has deteriorated. You also have Walmart higher by almost 7%, 6.6%. But a few people have raised the point that that's not necessarily a good sign for the economy here when you think about the trade down that Walmart often benefits from.
Right, and that's what we've been seeing widespread across a lot of the retailers here. We are still seeing this theme of the consumer trading down. It's a very tough macro environment. I mean, if you take a look at Walmart, you think about that as a potentially cheaper name. You have TJ Maxx, that's like an I don't want to call it off-brand, but it's definitely like a lower price retailer if you think about it in that sense. But then you did see the likes of, say, Target struggling here. A lot of people still talking about those tariff concerns. And it's really about them all trying to meet the consumer where they are. And some people actually have the foundation to support that. But then you are seeing other companies struggling with that mindset.
Have you done your Christmas shopping yet?
I haven't.
Okay, exactly.
Procrastinator.
So, there we go. Yeah. Get started, Norah. What are you waiting for? I mean, it's November 20th.
I was going to say, we're going to get Gap earnings after the bell, but, you know, holiday shopping too.
And Black Friday around the corner.
Jeans.
That's true. Jeans.
Ross
very
stores,
important.
too.
Yeah, there you go.
I went into our Ross stores once.
That's interesting.
Just once.
I walked out pretty fast.
We'll talk about it in the break. Norah Mulinda, she is Bloomberg's markets correspondent, joining us to talk about what a wild day in markets. We're driving you to the close. Up next.
We are starting to lean toward them skipping this meeting, again, based in part on the fact that it sounds like a lot of people on the committee are similarly minded. Also, you didn't see any real, while the unemployment rate did tick up, the momentum in the labor market may be turning around. That's a little soon to say. We wish we had more data.
Mike Feroli over at J.P. Morgan talking about some of the economic data that's contributing to a little bit of the malaise in markets today. Katie Greifeld, a big flip-flop today. We were up about 2% on the S&P at one point, and now looks like we're down about 1.5%.
Yeah, those gains certainly feel like a long time ago. We are at the worst levels of the session as we count down to the close. I will note that when it comes to the S&P 500, there's a lot of muscle behind this sell-off. Trading volume about 17% higher than the 30-day average, and a lot of that is coming through in tech. The NASDAQ 100 off by more than 2%, and Bitcoin, bad week gets worse, now down about 4%, Romain. The VIX, as you would expect it, higher.
The VIX is higher, but it's kind of funny. We would normally look to the VIX as being the fear index, the fear barometer, but I'm actually starting to look a lot more closer at Bitcoin and crypto as a fear barometer, because when you start to see that momentum really break down the way it is, I mean, what does that say about the speculative
That
trade?
is the use case for Bitcoin. It's a great way to measure sentiment because it has no fundamentals. You get a real tell for how people are feeling.
All right, well, I'm glad I finally came up with the use case for Bitcoin. Add that to the Wikipedia page and make sure you source me. We keep it moving right now, counting it down to the closing bells, just about 8 minutes away. Elizabeth Burton joins us here in Studio 2. She's the managing director, also a client investment strategist of the Client Solutions Group at Goldman Sachs Asset Management. Elizabeth, great to have you here, particularly on a day like today. And we should point out the sell-off we have today. I mean, this isn't some big fall off the cliff kind of moment. We're nowhere near correctionary on the major indices. But we have seen a shift in sentiment, I think, over the last 3 to 4 weeks, where people are starting to evaluate this big rally that we had this year. Is that a function of the fact that we're at the end of the year, or is this a function of the fact that people are now taking a closer look at fundamentals?
I think there's a lot of things that could be driving this. I think the good part about my job is I work with mostly institutional clients who don't have to worry about some of the intraday, intra-week, intra-month volatility. We just came out with our 2026 outlook, and I was thinking about the volatility today, and I was thinking, well, it's not 2026 outlook for now, for the next 15 minutes, it's for the year. So we're trying to focus on the durable themes that we think will continue to play out despite what's happening in the short term.
Mm-hmm. So what are some of those themes?
Glad you asked. So on the equity side, we are down and out quant and active. So down in cap out of the U.S., focusing on quantitative strategies and also active strategies. Within the fixed income and credit space, keep calm and carry on, which is good news for our investors who are still waiting back on some of their distributions to get back. They're looking for opportunities for carry, and we think next year might be a ripe opportunity for that.
Well, it's interesting. I mean, you think about both the credit space and the equity space. There's a Venn diagram there, and at the center is valuations. You think about spreads right now when it comes to...
I like that, Katie. That was clever.
Thank you. Yeah, I sort of, I don't know. I was wondering where I was going to end up. But in any case, you take a look at spreads on both investment grade and on high yield, and we're still at very tight levels to treasuries, even with a bit of the indigestion that we've seen in the past week or so. I mean, how are the institutions that you're working with feeling about those valuations, specifically in fixed income?
Right. So you and I, when we like something, we can get in or out or do nothing. Institutions can't do that, right? They have to continually stay invested. So I get asked a lot about the credit markets. Do you think now's the time to invest in credit? Well, if you have to always be invested in credit or in equities, it's more of a relative value play, right? So what looks more attractive when you know you have to put $1 into these categories or sit in cash?
Yeah.
And I think we would recommend not sitting in cash. So it's a relative value play. And On the credit side, high yield might look better on a risk-adjusted basis going forward. We still think the technicals look good for investment grade. However, we're seeing a shift more towards the private side of investment grade credit.
Well, let's pretend I'm an institution and tell me why I shouldn't just sit in cash, especially as maybe some of the more aggressive cases for the Fed's rate cutting trajectory maybe come off the burner?
Well, at the very moment, cash on its own is not going to get you to your return target. Most institutions in the U.S. specifically are targeting somewhere between a 6 to 7.5% return target, and doing cash alone is just not going to get you there. So you're going to run into funding problems with that. And there are areas of opportunity, right? So despite the headlines, we still think that things are looking constructive for equities. We're still risk on there. We're still risk on in certain parts of the credit spectrum as well. So we think there's opportunities no matter where you want to look, even if you think there might be too much concentration in the U.S. markets. So one thing that we've been talking about a lot lately, we think there's opportunities for small cap, both in the U.S. and ex-U.S. We think with quantitative strategies, there's opportunity both in emerging markets and as well as in Europe.
Yeah.
And I think Europe kind of surprises people. But we've done some research to show that the pricing mechanism there, the digestion of information is slower, could be an opportunity for people to employ a quantitative strategy to capture those effects sooner.
Well, I'm curious about the small cap side, and if maybe you could kind of explain a little bit more why there's opportunity there right now.
Right. So we've been talking about this a lot, and I know the question is always, is that rate dependent? Is it dependent on a rate cut happening in December, which, by the way, we think is still likely to happen despite some of the news that happened today. So I think one thing that I'd point out about small caps is that the inter and intra stock correlation right now is at the lowest that we've seen on 5th and 10% in the last couple years. So there's a lot of alpha opportunity there. In general, people tend to think about the index and small cap, and we're not talking about that, right? We're talking about other opportunities. The other thing I like about small caps is we've seen a lot of our institutions coming to us and saying, we want some way to diversify away from our exposure. And they might say something like a low volatility. Well, with small caps, like specifically something like small cap growth, you can capture more of the upside. You're going to capture more of the downside than you would versus low vol, but you're not cutting yourself off on both sides.
And it's hard to talk about a 2026 outlook without bringing in the private markets in some capacity. Right now, there is a lot of hand-waving going on about what's going on in private credit. There's a lot of worries about cockroaches, and there's just a lot of worries that, maybe some of the due diligence hasn't been up to snuff in that market. So when you take a look at 2026, what is the expectation there?
On the due diligence comment, I can understand the comment, but I guess the question would be, how can you do any on workouts and defaults when there really hasn't been a cycle yet, right? And when folks are talking about the problems in private credit, to me, it's almost like saying, I don't like animals. Well, what kind of animal? There's a ton of animals. There's a ton of private credit, right? Yeah. So we see opportunities in certain parts of the private credit spectrum. Real estate debt, for example, which institutions have had a really tricky time allocating to, because for years it was, is it real estate? Is it debt? But we're seeing largest issuance since 2007 this year to date, about 125 billion. And we think there's going to be real opportunity there going forward, especially in places like construction lending. We also think there's opportunity in credit secondaries, something that a lot of investors have not taken the opportunity to really look at yet. But there you're getting your cash flows back earlier and you're getting diversification. So there's a ton of opportunities, it just may not be the ones you were thinking about last year.
All right, Elizabeth, I have to leave it there. Really smart conversation, some great insights here. We have to get her back here for a longer conversation as we move closer to those closing bells. Elizabeth Burton over at Goldman Sachs Asset Management with stocks right around the lows of the session, just a smidge off, but still we're looking at some pretty significant declines here on the day. 2% on the NASDAQ, 1.5% on the S&P 500. A full breakdown of all of today's market coverage. It starts with our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with the global simulcast. Carol Massler, Tim Stenovec join us from the radio booth as we bring together our audiences across all of our Bloomberg platforms, including our partnership with YouTube here on what's shaping up to be the widest trading session for the S&P and the NASDAQ since those Liberation Day moments that we had back in April. A big downdraft today, Carol Massey.
Yeah, those swings, right? That's what's kind of catching us by surprise. I mean, just look at a name like Nvidia, right? Still trading off of those results. When they reported last night, we saw the stock rally. It initially opened up about 5% or so. It's been down as much as 3.6%. I mean, quite a swing. What, 8, almost 9% there, just on that name alone. So that's kind of where we are right now.
Yeah, taking a look at the S&P 500, it was as high as close to 2%, 1.93%, Katie, early this morning, down as much as 1.63%. It started moving lower just before 11 a.m., between 10 and 11, and now hovering at its close to worst levels of the day.
Yeah, it's interesting to think about what is doing well right now. Your biggest gainer, which I know we're going to talk about, is Walmart. But that, could be worrisome as well when you think about consumers perhaps participating in that trade down. That would certainly benefit a Walmart.
And also, there are a lot of concerns about the results that we got out of Nvidia. And we kind of missed this last night because we were talking about those monster revenue growth numbers. But when you took a closer look at the buildup in inventories and, of course, that big buildup in accounts receivable, the idea that they're selling things that they haven't been paid for yet, the growth rate on both of those metrics outpaced the revenue growth number itself. That's a big part of the reason why you saw Nvidia flip from a 5% gain at the open to what looks like about a 3% loss here at the close, and that's dragging down all of the major indices that it's a part of. The S&P 500 down about 100 points on the day, or about 1.5% from peak to trough today, about a 240-point swing, the widest swing we've had in the S&P 500 since April. The NASDAQ down almost 500 points, or 2.2%. The Dow Jones Industrial Average down 387 points, or 0.8%, and the Russell 2000 also moving lower by about 43 points, or 1.8%.
And we do have some breaking earnings news right now. Let me just jump in and break into it. The first quarter adjusted EPS beating estimates. That's coming in at $3.34. The estimate had been for $3.09. So quite a beat there. But then you take a look at some of the other metrics as well. Net revenue coming in for the quarter at $3.89 billion, also ahead of expectations. When you take a look at the guide ahead, they see second quarter revenue about $14 billion to $15 billion. Our headline saying that the estimate was for $4.48 billion, which certainly seems like quite a beat. We're going to try to get you some more context around those numbers, but currently down about 2%.
And just a reminder, we are expecting to get some other earnings today, including from Gap, bullish, as well as Ross Stores. In fact, Ross Stores crossing the wire right now as we speak. EPS does look like a beat for the most recent quarter, $1.58 versus estimates on the street for $1.40 on average. Sales up about 10% on a year-over-year basis to $5.6 billion. That's over street estimates of roughly about $5.41 billion. Total location count up about 1.8%. Inventories also higher, though, up about 9.4%.
And we do have some more context around that second quarter revenue figure. Certainly seemed wild. It was reported in our second quarter revenue seen about 14% to 15% higher for the second quarter. So there you have it.
All right, continue to track.
For Intuit.
Okay.
Intuit, okay, yeah. Intuit out, Ross Stores out. We've got Intuit down about 2% here in the aftermarket. Hey, I'm going to go to some of the individual gainers. Katie, you mentioned Walmart. It is your number one gainer in the S&P 500 today, finishing just off its best levels of the session, up 6.5%. Company, world's largest retailer, as you know, raising its full-year sales and profit outlook. So it's a sign that Walmart is winning over price-sensitive shoppers while absorbing rising costs. The upbeat outlook driven by strong e-commerce performance and a wide assortment of products, including luxury items like pre-owned Chanel bags, which I had no idea that they were. I know. Did you know this?
No.
Yeah.
I don't.
I read that in our story.
It might surprise you. I'm not really in the market for a pre-owned Chanel bag.
Well, if you're thinking about gifts for people that you love. Anyway, so Walmart definitely an outperformer.
I give them experiences.
That's actually really loving, too. Regeneron, that went up about 4.9% in today's session. That, folks, number two gainer in the S&P 500, and I think it was also a top gainer in the NASDAQ 100. That one, as I mentioned, up as much as 7%, but finishing the day just shy of a 5% gain. It was halted last night, you might recall, about 24 hours ago after the close. Late yesterday and then today, the stock rallying after the FDA approved a higher dose of Eylea, I believe it said, to treat patients with macular edema following retinal vein occlusion. I'm not a doctor, don't play one on TV, but nonetheless, this was seen as a good sign in terms of indications for that drug. And also, Leerink Partners coming out and saying that this from Regeneron is on a better footing compared to a rival drug from Roche following the approvals. One more name I want to mention, Shoot. Cipher Mining was up 20% at its high today. It did finish down 0.4%, so I'm really sorry about that one.
I didn't understand.
Cipher Mining was up 20%. It rallied big time today. This was after it's a $6 billion market cap Bitcoin miner and data center operator. It signed an $830 million AI hosting agreement with Fluidstack. Blah, 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 with additional backstop from Google. But apparently by the end of the day, investors weren't impressed. Sorry about that. That's kind of a...
Welcome to my world of decliners, Carol Master.
Was a gainer, now a decliner, over to 2.
Okay, well, let's start with Nvidia, the big one today, finishing down close to 3% on the day today. Shares initially climbed more than 5% after stronger than expected revenue forecast. The rally faded, though, as investors worried about AI spending. And at first, investors liked what they saw late yesterday, early today, at least with revenue and guidance for the data center division. But as Romain said earlier, concerns when it comes to inventory buildup and accounts receivable. Once again, shares closing down close to 3%
Can I just add one honorable mention out of that? There was a huge downdraft today in SanDisk. And remember that big run-up that we saw?
How do you know I wasn't going to get to that?
Oh, I don't know. Were you?
No.
Okay, anyway, you got me on that. But no, I mean, we talk about a 20% drop today, but really, I mean, it's down like 30% since it hit that all-time high, just I think it was like last week or the week, whatever, whenever November 12th was. But it gets to this idea that a lot of people are saying that now you're starting to see weakness in the memory makers now being dragged down by some of the issues going on with the broader AI trade.
Yeah, SanDisk shares ended up falling today by more than 20%. But usually, Romain, you save the honorable mentions for when I'm done with all three. But this was a really important one.
Thanks
That's
for
okay.
pointing that out.
Strategy, the company formerly known as MicroStrategy, shares took a hit today. The company now faces the risk of being dropped from benchmark indices such as MSCI, USA, and NASDAQ 100. Shares today fell by more than 5%. JP Morgan Chase analysts out with a note earlier this week that warned that exclusion from major indices could lead to a loss of liquidity, higher funding costs, and decreased investor appeal. The decision on inclusion comes January 15th, as much as $2.8 billion potentially exiting if MSCI moves ahead with exclusion. Now, at its peak, the market's capitalization for Strategy soared above the value of its holdings, but the premium that's been there for so long with Strategy has pretty much vanished right now. So the valuation is really around how much crypto it actually has in its reserves right now, and that's a sign that investor belief is thinning quickly. And finally, Bath & Body Works shares took a tumble today. At one point, down more than 20%, ended up closing the day down 24% to the downside. This after the company cut its full-year adjusted earnings per share forecast. It cited negative consumer sentiment, Romain.
All right, let's take a look at the yield space here. The entire yield curve on this day taking a bit of a shift lower, but that is not necessarily a broad endorsement of conviction that rates by the Fed are going to come down 4 to 5 basis points lower here across the Treasury curve. But still, when you look at the implied probability on the Bloomberg terminal of a rate cut at the Fed's December 10th decision, still a bit of a split decision right now based on what people are betting on.
All right, we're going to talk a couple of AI stories on our radar, folks. One is about how Wall Street wants everyone using AI except its job applicants. So banks, they're using virtual interviews, online tests to screen applicants, but they're taking steps to make sure the candidates are not using AI to improve their chances of being picked. They basically, I mean, in a nutshell, they want to make sure that these folks know how to think.
What, critical thinking? That's what they're looking for, critical thinking.
It actually matters.
But don't be confused about this. They want people who are hired to know how to use AI. Some executives say they want colleges and universities to train students to be skilled at manipulating large language models, but just make sure you're not using it to do the application and kind of get through that interview process, I guess.
Yeah, it's funny because I'm sure that they're using AI in some capacity to screen the applicants, but the actual applicants.
You're still not using AI, Katie? That didn't change since yesterday?
I don't know, you know.
Well, there's another impact in all this, too. I mean, given all the focus on artificial intelligence and the fact that a lot of those artificial intelligence companies are private, we're actually seeing a lot of the analysts on Wall Street that would normally be covering public companies now starting to shift their attention to private markets. And that's actually causing a bit of a ruction there in the, I guess, financial industry labor market.
Well, it makes a lot of sense because you think about private companies. I'm talking about OpenAI having such an impact on the fortunes of public companies. I love this quote from Anne Malone. She is head of U.S. equity research over at Citigroup, saying that the demand from clients is huge. And basically, everyone wants to hear about private companies for one of two reasons. They either want to invest in them or they want to know about it because they might be a threat to your investment. So it's a real sign of the times here.
Yeah, we want to know more, right, about all these privately held companies.
I just don't know how you do it as an analyst when you don't have access to that information.
It's hard.
Yeah, it's called work.
Maybe ask.
You don't use AI.
Can we ask ChatGPT? Like, can you tell? Yeah, I know. I see that circular.
Watch out for the
thing.
hallucinations.
All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Katie and Romain continuing there on the open on Bloomberg TV. Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. We'll see you again, same time, same place tomorrow.
All right, the markets are closed, but there is still a lot of activity in the after-hours session. Earnings out of Ross Stores. We're awaiting earnings out of Gap and GE Healthcare in a deal to buy Interrad. Stick with us. We'll be back in a moment. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic. A big downdraft in stocks today. We started the day with a big pop at the open here, but that quickly faded as a lot of people started to reassess some of the earnings that we got out of Nvidia, which were good, but some concerns here about whether there was actually quality to them. We also had good earnings out of Walmart, but again, sometimes a contrarian indicator on what's going on in the economy. The S&P 500 down 1.6% here on the day. The NASDAQ down about 2%. Chip stocks down about 5%, a big uptick in the VIX here on the day. And the real fear index right now, Katie Greifeld, appears to be Bitcoin trading just below 87,000.
You have to wonder how low it can go. Maybe we'll find out in the days to come. But let's take a look at one of the notable movers in after hours trading. Ross Stores reporting earnings, a beat and a raise quarter. Comp sales also coming in above expectations. Shares up about 2% in the after hours as we await Gap. And our top story this hour, wrapping up a big week of retail results. As I mentioned, Gap earnings due any minute now, providing yet another read on that consumer. Now that follows results out of Ross, Walmart, Target, and more, and all told signals on the health of the U.S. consumer. They remain mixed as economic growth cools and the job market weekends. We did have a new survey from credit reporting firm TransUnion showing that Americans are planning to spend more this holiday season than last year. But as we heard from Mickey Drexler, he's a little bit skeptical there, Romain.
All right, well, let's see if our next guest is skeptical. Jharonne Martis joins us right now, Director of Consumer Research over at LSEG. And Jharonne, I'll start with a broad question here. I mean, we've heard from Walmart, Target, we got Ross Stores just a few minutes ago. And over the next couple of weeks, we're going to hear a lot from retailers, those reporting earnings and those also reporting their Black Friday performance. Are you optimistic at all for this holiday season?
So our LSEG data shows that over this year, we've seen earnings drop significantly compared to the previous 2 years, where earnings growth rates have been in the double digits. Currently, for the third quarter, we're looking at a 7.2%, which is a high single digit, but this is expected to remain muted for the holiday season.
7.2% growth.
Yes.
Now, is that inflation adjusted or not?
Yes, it is.
It is. Okay.
And so what we're seeing is that for the holiday season, it's expected to remain muted and below the double digits that we've seen in the previous 2 years.
What is driving the consumer right now? Is it that they either don't have the money or they're just concerned, they're just having jitters about the economy, so maybe they'll be a little bit more restrained than they would have been?
So our latest reading on LSEG consumer confidence shows us that the biggest concern is expectations. They are very much concerned about the future of the U.S. economy and also their job security. And so if they start feeling that their friends and family are losing their jobs. We saw that the job market, the unemployment number today tickled up to 4.4%. But if they feel that this number will continue to rise, that's when they're going to put their hands in their pocket and hold back on spending and become even more conservative than what we are already seeing this year.
And talk to us a little bit, too, about the psychology here when it comes to promotions. This is a conversation we were also having with Mickey Drexler that, perhaps there's consumers that are just waiting for those promotions to come. They've been conditioned to sort of wait, especially around holiday season.
That is absolutely correct. We have a very discerning consumer that's doing a lot of price comparison. And in a collaboration with Centric Market Intelligence, we discovered that this year has been the lowest we've ever seen in terms of promotions, meaning the average discount offered to the consumer, and also the amount of merchandise on sale has been lower to even compared to pre-pandemic levels. And this is mainly because the retailers are worried about demand in this economic climate, and also the fact that inventory levels don't want to hurt their margins.
All right, we're in conversation right now with Jharonne Martis over at LSEG. We're getting results out of Gap right now. The share is popping higher in the after-hours trade. Total comp sales in the third quarter up about 5%. The street was looking for about 3% here, so a beat on that main metric. Old Navy comp sales up 6% in the quarter. The Gap Global comp sales up 7% in the quarter. Banana Republic up 4% in the quarter. And Athleta, believe it or not, down in the quarter 11%. That was a big miss on that one, but the other three brands, Katie Greifeld, appear to have beat the average of analyst estimates.
Well, as we keep talking about athleisure, very competitive. And Jharonne, let's talk a little bit about comp sales, because Gap now total beating there when it comes to that metric. Ross Stores did too. I mean, how do you read those sorts of figures, especially in the environment we're in right now?
I think what is very important to note is that this is Gap's strongest same-store sales since 2021, when we had easy comparisons because of the pandemic. If you remove the pandemic effect, this is Gap's strongest same-store sales since 2017, so the strongest comp in 8 years. So it underlines the brand recovery that we're seeing right now going on with the retailer. Not only Old Navy, who has consistently been strong, but especially Banana Republic, who had been struggling throughout the years. A lot of it has to do with it resonating with Gen Z and millennials. Yeah. And what we like is that it's been selling full price. Gap is always known for at least 40% discount. Yeah. And selling full price is a big change.
How much do you think they can continue that? We should point out they're providing their full year forecast. This is for the fiscal 2026, 1.7 to 2% growth on a net sales basis. That's basically a narrowing of the forecast that they are previously given. But we should point out this will be the first full fiscal year that they've had actual growth on that metric since I think at least 2022.
That is correct. Yeah. And so what we're seeing is that more consumer engagement with a younger generation, and they're doing this through their advertisements. A lot of their marketing has always been like using artists, and now they're using younger artists that actually resonate with Gen Z and millennials, and that's selling well.
Okay, so they're not marketing towards old people like me anymore. Is that what you're saying?
Well, they're changing their focus and trying to be more focused on social media and targeting the younger crowd.
They're just changing their focus, Romaine. Don't worry about it.
All right, that's all right.
But they still haven't forgotten about you.
I hope not.
Banana Republic caters to everybody.
It's always fun going to concerts of old artists and realizing that everyone in there is old and gray. And I'm like,
it's a great way to feel young.
Yes.
Not really.
It's how you frame it.
There you go. Yes. Jharonne, great to spend some time with you. That is Jharonne Martis. She is Director of Consumer Research over at LSEG. Go on.
I think we have some breaking news that we need to get to here coming out of the newsroom and crossing the wire. This on Citigroup. CFO Mark Mason at Citigroup appears to be out, a transition being announced by the bank right now here. We're going to try to get you some more details on that, but the main headline is that Gonzalo Luchetti is now being named CFO of Citigroup. Mark Mason, who had been holding that role for quite some time, will be transitioned out of that role by March of 2026. We're going to get you some more data on that in just a second. We'll be back in a moment. This is Bloomberg.
Let's take another check on those retailers reporting in the last few minutes. Ross Stores and Gap, you can see shares of both higher right now, 4% for Gap, 3.5% or so for Ross Stores. And this, as we're set to get another read on the consumer with September retail sales finally out on Tuesday. Our next guest saying the K-shaped expansion will likely continue for consumers and firms. Joining us now is Torsten Slok. He is Chief Economist and Partner over at Apollo Global Management. Torsten, great to talk to you as always. Unpack that a little bit, the K-shaped economy, how it plays out for consumers, because taking a look at these retail results, it's been a mixed picture so far.
Well, as you just talked about earlier, Walmart is an example, of course, of where things are still good. And the question, of course, for us in the market, especially from a macro perspective, is that a result of people trading down, or is that a result of consumption still being fine? So there's still a number of issues when we get these retail earnings that are raising some questions around what is exactly the source of why things are still okay. But if you look at the weekly data for same-store retail sales from Redbook, it continues to be steady. So, and meaning relatively solid, growing around 5-6% nominally year over year. So going into next week, and of course, some of the things that we're getting are still like the non-farm payrolls numbers for September, but it still looks like the economy is doing just fine. There's a lot of fears about a sharp slowdown that we're just simply not seeing.
Well, I want to talk about what this means for the Fed, because in the wake of that delayed September non-farms payroll print, we saw Morgan Stanley saying that they now don't expect the Fed to move in December. We heard something similar from Michael Feroli of J.P. Morgan earlier on this show, basically expecting the Fed to skip this meeting. And Torsten, I wonder, when you add it all together, where you land on that question.
I agree with that. I don't think the Fed will be cutting rates in December. I mean, think about it. The Fed's dual mandate is inflation, and it's the labor market, full employment. Inflation at the moment is around 3, both headline and core. And the labor market, the numbers we just got today, it's still more than 100,000 jobs created. And this has to importantly be compared to a benchmark of where the equilibrium rate for job growth is now, according to the Fed, closer to 30,000. So from this perspective, 119,000 is actually a pretty good number. So taken together, to your question, Katie, I do think that if you look at the dual mandate, inflation is still significantly above the target. And at the same time, the labor market is still okay. And this also, by the way, the jobless claims numbers earlier today also still shows the same story, namely the labor market's okay. Well, all that indeed argues for at least waiting a little while longer to think about if there are more cuts that are needed.
I am curious, though, Torsten, is there real progress in this economy right now? I know we can look at these numbers and find some modicum of stability, but is there real progress, real growth?
Well, this is also a very important question, Romain, because if we think about what was the reason why we had a slowdown over the summer, it was likely because of the turmoil that came after Liberation Day. But Liberation Day is now 8-9 months ago, and things are gradually getting better on the trade front. At least there's more clarity, and we've, of course, signed a number of trade deals over the last several months. All those things at least means that uncertainty has been coming down. And at the same time, the one big beautiful bill next year, according to the Congressional Budget Office, is going to lift GDP by almost a full percentage point. So if I combine lower degree of uncertainty and at the same time some fiscal stimulus coming in the next several months, then we will also begin to see the economy reaccelerate as we go into 2026. So the bottom line is we should expect the labor market to bottom out at where we are now and then things to get better as we go into next year.
Torsten, I want to talk about what I continue to see as a bit of a disparity between what we're seeing in the official data and what we see in some of the sentiment indicators, and as well as a lot of the anecdotal evidence, including what we're getting out of the Fed Beige Book. The idea that a lot of folks on the ground, they're still going into the grocery store, going into retail stores, and in their view, still seeing higher prices, and they're still concerned about why they haven't come down. And I am curious as to when that becomes a concern for economists like yourselves, and more importantly, for the White House and Congress.
And this is, of course, very important, Romain, because if you think about that question from a macro perspective, it is exactly the question of when will the upper leg of the K no longer be able to drive things fast enough, and when will the lower leg of the K begin to become such a big problem that it begins to have a more heavy macro impact. And it is very clear in the sentiment data, exactly as you're highlighting, that things have not been particularly good on a number of different fronts. And it is also clear, as you're highlighting, that affordability in so many different ways is weighing on the sentiment outlook overall. But we still look at the incoming macro data, such as the employment report today is still very good.
Right.
Look at jobless claims. People are still having jobs. They're not getting unemployed. And at the same time, inflation is still too high. The Fed really has no other choice than to stay on hold in December.
Well, that's where I want to go. When it comes to inflation being very stubborn, it's not moving down. It's kind of clear that rates at this level aren't the cure for inflation and bringing prices under control, Torsten. So at this point, what do you think it will take?
Well, and that's why, of course, this debate at the FOMC is just, fascinating, that there seems to be a group of individuals who are very data dependent and looking at the incoming data, and the incoming data, which we've been talking about here, is basically telling us we should not be cutting. Then there's a different group of individuals who are saying, well, on the other hand, we have at the same time that we have a measure of R star, which is model dependent. And that measure of R star, you could argue, some people think it should be higher, some people should be lower. But some people hang their hat on a model, other people hang their hat on the incoming data.
Yeah.
And I do think that the incoming data should get the most weight. And incoming data that's been getting today, jobless claims, non-farm payrolls, it does say that we should still be very cautious with cutting rates in this environment.
Torsten, always a pleasure. Torsten Slok, chief economist and partner at Apollo Global Management. We do want to go back to that breaking news just a little while ago on Citi, learning that CFO Mark Mason will transition out of that role by March of next year. Now, he will stay with the company as an executive vice chair and a senior advisor directly to CEO Jane Fraser, but some other big changes being made, particularly in the retail business here. A lot of that consumer side of the business being folded under the wealth business here. We're going to get you some more details on that and bring it to you as soon as we come back after the break. This is The Close on Bloomberg. We return to that breaking news on Citigroup, the bank announcing that CFO Mark Mason will transition out of that role in March of 2026, being replaced by Gonzalo Luchetti. There's also some big changes going on with regards to the personal banking business there as well. Todd Gillespie, Bloomberg reporter covering the banking sector, joins us right now. Let's first start off with Mark Mason. He's been in that role for quite some time. There had been a lot of speculation about what his future would be, whether he would be elevated at some point. Is this basically an answer?
I think it is, Romain. And I mean, Mark Mason was CFO, let's be clear, before Jane Fraser was even CEO. Mark Mason has been in that CFO seat a long time. He's been responsible for a lot of the transformation plan that the bank has been trying to do, a lot of the back office work, fixing regulatory issues that have largely been underneath his department as CFO. We know, there were reports earlier on his career that he was, in line to be CEO of Carlyle. He'd had chats with people outside the bank. It seemed like he was quite keen to stay on, potentially throw his hat into the ring. But bear in mind, Jane Fraser has just kind of solidified her position at the top of Citigroup just a couple of weeks ago, becoming chair of the bank as well. That's the first time the CEO has also been chair of Citigroup since 2007. So Jane Fraser seems to be not really going anywhere anytime fast, and also therefore sort of, integrating herself or sort of, stabilizing herself atop that bank. And now seems to be a time for maybe Mason to move on and for a refresh at the top as well.
Right, and we see the shakeout coming through. So just to go down the list of some of these changes, retail banking and U.S. Citigold to be integrated within wealth, reporting to Andy Sieg, which is interesting because you've reported that he's someone who's recently been investigated.
That's right, Katie. Yeah, I mean, Andy Sieg, this is a big expansion of his empire, essentially. Gonzalo Luchetti, who's becoming CFO, he's head of the U.S. personal banking business. That's now being merged into wealth underneath Andy Sieg. So Andy Sieg's empire is essentially growing from all the way up to the elite private bank, the international billionaires that Citi serves, all the way down to the retail business. The cards business is being spun out into its own unit underneath Pam Habener, who is a big executive in that space. She launched some of the big Sapphire brands at J.P. Morgan when she was there before she joined Citigroup. But yeah, it's a big moment for Andy Sieg, who, as you say, Katie, was reported to be under investigation and was under investigation for mistreatment of employees, senior executives around him as recently as this summer. Jane Fraser has said that she's comfortable with where they got to in that investigation, and the bank has stood by him and indeed even given him a promotion now.
I am curious, too. They also talk about in this business how U.S. consumer cards are now going to be one of their core 5 businesses. Now, I was always under the impression that Jane Fraser was trying to move a little bit away from that. Is that just a mischaracterization?
Yeah, what Fraser was trying to do was pull away from the consumer banking internationally. The international consumer banking business for Citi didn't seem to be that profitable. They were kind of trying to double down on the US in the way that a lot of banks like J.P. Morgan as well have doubled down on their branch business in the US. Citi is also still trying to do that. Their cards business is pretty profitable. They've just launched a new Strata Elite credit card. They've got partnerships with a lot of the payments companies now. And that is a growing and profitable business for them still. So spinning that out and making that its own discrete business, it maybe makes sense for them strategically.
All right, Todd, I really appreciate your reporting there. That is Bloomberg's U.S. banking reporter, Todd Gillespie. Some interesting changes at nearly the very top of Citigroup, Romain.
All right, when we come back, we're going to talk about the power of branding. In focus this week, of course, with all the retail earnings, but it also applies to the financial sector as well. We're going to catch up with Jenna Lyons, signer and partner at Fundamentalco, and Jonny Bauer, the founder and executive chair of Fundamentalco, here to talk about the future. That's coming up next year on Bloomberg.
We are flying right now.
Yeah.
Took 5 years to get there, but it's all about the product. The marketing is critical, and the team. No one does it alone.
And that is Mickey Drexler, of course, the current chairman of Alex Mill, formerly of J.Crew and Gap. I think our next guest knows a bit or two about him. And of course, he gets lauded as being an expert, really, in the retail space and really helping to create and build brands. There's also a company out there called Fundamentalco, which a brand-led consulting firm that was carved out of Blackstone that's trying to take that to the next level. In addition to working with public and private companies, the team is now working with private equity clients as well, including names like Bain Capital and Thrive, as they look to execute their brand strategy. Joining us right now, I'm pleased to say, is Jenna, Lyons, designer and partner at Fundamentalco, and Jonny Bauer, the founder and executive chair of Fundamentalco. Great to have you both here.
Thank you.
Thanks for having us.
You were chuckling because obviously you've had a relationship with Mickey over the years,
Many years.
given your experience in the retail sector. But I do want to start just overall with this new venture that you have. I mean, you're roughly about 2 years into Fundamentalco. You've had some big changes at the top, obviously with Jonny, with yourself, and now with the new CEO who's going to take things, I guess, to the next level, wherever that may be.
I mean, it's been exciting. We started with this idea, and it's really a new idea. We're taking this idea of value creation, but really putting brand at the center. And I think when you look at the traditional marketing, it often gets segmented separately from strategy. And what we've really done is trying to join those two things. And I think my experience with Mickey and really understanding how brand needs to permeate every level of what you do, it's what people remember. It's the touch points. It's what's the center of gravity of your company. And that's just as important, but sometimes it gets relegated into a logo or a marketing campaign. So in the past 2 years, we've really made an effort to bring those two things together and also to share with PE firms who may not be as used to this kind of conversation, how important and central it is to the business we do. And so, we're 2 years in and we're growing. We've just hired Alex Lubar. We have a new CEO, and it's exciting. So Jonny's now not in the day-to-day, which I think is good for him, and it's allowed us to really step up and focus on the next phase.
So, Jonny, I am intrigued by some of the work you're doing with some of these private equity firms. We've talked a lot on this program about sort of the capture we've seen with a lot of the sponsored companies, the idea that they're staying private for longer, they're not able to go public, some don't want to go public, but it also means these PE firms, they're not just investors anymore, they are real managers of these companies. What does a branding experience look like when you're working with financial engineers who maybe aren't necessarily well-versed in branding?
Well, firstly, I want to say that I'm very much still in the day-to-day in Fundamentalco. I'm just taking on a slightly different area of focus. But to answer the question, what we do, regardless of where a company is in its investment cycle, whether they've just been acquired or whether they're getting ready to sell, we help orient the company with the around a set of ideas that define what is the company's next chapter, and is the company transforming into its most valuable potential form. So when a company is acquired, what had typically happened in this PE-backed context is they'd buy a company, then there'd be a lot of interventions, and then they'd bring the brand people at the end to say, who are we? And why we exist is to really bring that brand thinking much further upstream in the sequence of value creation and ask the question, what could this company become next? And then tether all of the interventions to that set of ideas that create real alignment between the investors and the management teams. And we started the practice with inside Blackstone. They were the earliest adopters. And we spun ourselves out into an independent company 2 years ago. And what's exciting is that we've proved the theory out beyond Blackstone to some other big sponsors like Towerbrook and Thrive and Apollo and Bain Capital. And we're doing this work for a bunch of their portfolio companies too, as well as now some public companies are approaching us and asking, can you apply some of the learnings that you've had at the private markets to the public markets with a view to enterprise value?
Well, Jonny, that's what I was curious about, how you build up this roster of clients that you work with. I'm sure a lot of it is repeat business, but, are you going out and establishing those relationships, pitching, if you will, or are you at the point where, folks are coming to you?
Well, it's a little bit of both. Our business has grown 100% on referrals. And we are growing through doing more work for more portfolio companies within a pretty small group of sponsors. But they're all giving us more works and more assignments, and we are starting to now have the bandwidth to take on more sponsors and different PE firms.
And Jenna, you made the point that, a brand needs to permeate everything when it comes to a business. It's not just a logo. And I wonder, how often you see just plain missteps. I'm thinking about Cracker Barrel, of course. What a difficult summer they had. But I'm sure that, that's the exact type of situation you want to avoid.
I agree. And I think what's interesting is that that's where people get caught up. And they caught up in the idea that it's a visual, that it's a marketing play, as opposed to like a set of ideas that everything gets organized around. So who do you want to be? What do you want to say? What do you want the public to know about you? What's important? What is your mission? And then everything you do has to go back to that mission. So if it's really important to you to sell the best cheese in the world, then let's make every single decision around that. And oftentimes what happens is it gets separated to the marketing area, which it's really about the strategy that happens way upstream. And I think you asked the question about how do you get people in that world who don't really understand it?
Yeah.
When you lead it back to value, how does this add value? How does this create value? How does it continue to help you grow your value? It helps, I think, that team really understand the mission and what the advantages are.
I am curious, though. I mean, doing it further upstream obviously makes a lot of sense. Yeah. But what about sort of legacy brands that maybe have lost their way? I mean, we talk about the resurgence of J.Crew and Gap, Macy's, all these great brands that have lost a certain sort of cachet and identity. Can you get that back without having to completely rebrand?
I mean, it's a great question, and I think you can. I think the biggest challenge is in those moments, there's a lot of people that have been there for a very long time. So how do you galvanize them and get them organized around an idea? Because over time, there's like a creep. Everyone has a slightly different version of what they think that brand has become. And it's very hard. So I think oftentimes legacy brands are it's the most valuable because they need a moment to regroup, retrench, and say, what do we really care about? What do we want to be? What do we want to say? And how do we want to say it? And what are we doing from the very inception? What is our strategy, not just for tomorrow, but for 5 years? How are we going to get there? And getting everyone in a room to really agree on that and understand it in a similar way. It takes a lot of experience, and I think having had the experience, I've done it at J.Crew and Madewell Mickey too, you start to realize like bringing everyone in is just as it's not about just the CEO. While the CEO is important, it's really about bringing the entire team together to say like, your piece of the pie is just as valuable. You're in accounts payable. I want you to know what our mission is. You're actually in marketing. Of course you have to know, but every single person in the company needs to feel connected to the trajectory and what we're about.
Absolutely. Unfortunately, have to leave it there. Such a fascinating conversation. Really appreciate you making the time. That is Jenna Lyons. She is designer and partner over at Fundamentalco, and Jonny Bauer, founder and executive chair of Fundamentalco as well. Now, coming up, the CEO of T-Mobile joins us, hot on the heels of a big announcement at Las Vegas Grand Prix. More on what's at stake for wireless when we return. This is Bloomberg. T-Mobile making some big announcement at the Formula One Las Vegas Grand Prix, rolling out a new initiative called 15 Minutes to Better, meant to speed up and smooth out the transition when switching carriers using AI and same-day device delivery through DoorDash. Also announcing a multi-year extension as the exclusive 5G partner of Formula One. Let's get straight to T-Mobile CEO Srini Gopalan, who joins us live from Las Vegas. Srini, great to have you with us. Let's go one by one here. We'll start with, of course, the partnership. I always wonder what the return on investment looks like. To be the exclusive 5G partner of Formula One, how does that actually translate into your business?
So we love working with Formula One. I mean, there's two different things, right? One, the fastest network and the fastest sport both coming together. It's a marriage made in heaven. And we work with Formula One across a wide range of things, from using our technology at the event to actually using it for broadcast. It's also a very special moment for our customers because we have the ability to give them money can't buy experiences, which is such a big part of being a T-Mobile customer. So you have you have what's called Club Magenta, where they have exclusive access to things that money can't buy. So it's a combination of using our tech together with Formula One and giving our customers something back as a way of saying thank you.
And let's also talk a little bit about 15 Minutes to Better. Switch in just 15 minutes, your press release says, all on T-Life. You're using AI-powered tools to make that possible. But 15 minutes, that is not a lot of time, Srini. So how can you guarantee that you will actually get it done within that window? And what happens if you don't actually do that?
So look, I mean, switching is just totally broken as an industry today, right? I mean, it takes 3 hours to switch. And What we're saying there's three components actually of switching made easy. 15 minutes to better, which is the thing you just talked about. 15 minutes to better is all about us using the best technology from a digital and AI perspective. And we've been testing this for a while, and we're extremely confident that you can switch a line within 15 minutes. And you can do that sitting in your couch, or you can come into store and work with one of our agents. Either way, we can switch the line in 15 minutes. That obviously doesn't include things like transferring your data, but what's a process that takes 3 hours today is something we'll bring down to 15 minutes. And the reason we call it 15 minutes to better is it's 15 minutes away from a better network, from a better experience and better value.
I am curious.
The second component of this is, sorry, go on.
Oh, sorry, Srini, you could finish your thought there. My apologies.
Yeah, so the second component of it is when you get a new phone, today the carrier decides when, how, where you get your phone. This is putting control back into the customer's hands. And the last thing that you referred to, same-day delivery with DoorDash, because your phone is so important to you, you don't want to wait. The combination of all those three is about making switching easy and smashing through one of the biggest pain points in this industry.
I am curious, though, about some of the competition out there, Srini. I mean, obviously, traditionally, we stack T-Mobile up against a Verizon or AT&T, if you will. But we've also seen a lot of these upstart mobile phone companies, obviously just piggybacking on the big networks. But they have started to, peel off a certain group of consumers. And I am curious if that bothers you at all, or are you perfectly comfortable with sort of operating in the same space as those folks?
Look, we think of our mission and our job. Your earlier guest talked about the purpose of a brand, right? We think of our purpose very much as smashing customer pain points. That's what we double down on. That's what we focus on. And if our competition is doing the same thing, good luck to them. If they aren't doing the same thing, they'll best have to get out of the way. So we're very, very focused on customers and working back from what their pain points are and nailing those.
Is when we talk about the idea of these sort of wireless plans, Srini, is there any risk that we start to see consumers push for something a little bit different? I guess what I'm asking you is the traditional model, does that still have legs long term?
Maybe it's worth your clarifying what you mean by the traditional model, because there are so many models at play. So with T-Mobile, it isn't a traditional plan in many ways, because with your plan, you also get free Netflix on us. With your plan, you also get access to airplane Wi-Fi. With your plan, you also get a Dash Pass free. The amount of value you get with what you think of as a traditional wireless plan is so large, right, that I think we've already moved beyond the world, at least at T-Mobile, of traditional wireless plans.
I do have to talk a little bit more about the competition, because Verizon out with the news in the last week or so that they plan to cut their workforce by about 15%, certainly turned a lot of heads. And you think about your business, for example, T-Mobile. At the end of 2024, you had 70,000 employees. Do you have any plans to reduce headcount in the coming months?
See, I'm not going to comment on what Verizon's doing. I can only say, and you'd best talk to them about their plans on that. I can only say that what we're relentlessly focused on is smashing through pain points. You saw us do one today. You should expect a lot more of that, because we won't stop.
I do have to ask you, Srini, you kind of referenced our previous guest. We were talking about branding, and we've been talking about that a lot on this show. And obviously, T-Mobile is kind of one of the, iconic. Obviously, the color scheme and your predecessor, who has always made sure to be on brand in a good way. But it also gets to this idea of how to stay relevant, that as you mature as a company, what do you do to make sure that the next generation of folks are going to gravitate to a T-Mobile instead of, whoever the new person on the block is?
Yeah, look, our brand is as much about our culture as anything else. It is this incredible passion to smash pain points. And where we get a lot of that energy and passion from is our front line. I've got to tell you this, I've been in town halls in multiple companies where senior management stands up and talks for an hour and then takes questions for 5 minutes. Town halls at T-Mobile are totally different. I talk for about 5 minutes if I get the chance, and then there's 50 minutes of the front line pounding me with questions, telling me what I should be doing better, telling me how we can make the company better. Our brand is all about that energy, that passion to really solve customer problems, and that's most visible when you talk to our front line. That culture is what makes us different. That culture makes the brand.
One quick final question, Srini. I mean, I am curious about what differences you see in running a U.S.-based carrier like T-Mobile relative to some of your previous positions in Europe and the U.K. Is there a material difference in what customers are looking for and how you market to them?
Look, I think every country and every market structure is different. But I think one common bit across successful companies everywhere I've worked for is you work back from the customer rather than forward from earnings. At the minute you're working back from what is it that I'm solving for, how do I make them incredibly happy, and how do I create a culture that obsesses about it, you're bound to be more successful than when you start with here's the earnings growth I want and here's the math I'll do to figure out what I need to do with customers. That fundamental belief, I think, is true across countries and continents, and I'm privileged to have an organization that shares that belief with me.
All right, really appreciate you taking time for us today, Srini. Srini Gopalan, he is a new CEO of T-Mobile. Here, as we wrap up our coverage here on The Close, Katie Greifeld, and push ahead here to what could be another busy day tomorrow, including we're going to hear from one of the more prominent members, newer members at least, of the Fed.
Yeah, Stephen Myron, he'll be speaking here on Bloomberg. We're also going to hear from Williams, Barr, Jefferson, and Logan. A very robust debate happening in public right now.
And it gets to the question, are we going to see any consensus? Because it seems like every time we hear them speak, they're all saying different things, and I don't know if that bodes well for any sort of a consensus decision on December 10th.
Well, we do have some data coming out tomorrow that will inform the discussion. University of Michigan sentiment coming out, as well as wholesale inventories for the month of August. We're also going to see an interesting meeting happening at the White House.
Yeah, the mayor-elect of New York City, Zohran Mamdani, is set to meet President Trump at the White House. Of course, the federal government has a lot of control over a lot of big projects in this city, including a lot of big transportation projects as well. And if you're looking for some light listening.
Yeah, if you just can't get enough of my voice, the latest edition of the Money Stuff podcast with me and Matt Levine out tomorrow afternoon. We talk about Labubus and Blue Owl, Romaine. I'm sure you'll tune in.
I will. I hope to be a guest on this podcast.
Well, I can make that. I know a guy.
Do you have cameos or something?
Sometimes we do.
All right, all your politics coverage coming up here at the top of the hour with Joe Matthew and the Balance of Power team right here on Bloomberg.